Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Dallas, topic today is the market doesn't fall. There's just more sellers than buyers.
Thanks, Michael. This actually came to me basically refuting something that we ourselves say all the time. So we often talk about, when you're saving for retirement or in retirement and if markets drop temporarily. And what we're talking about there is if you've accumulated retirement savings that are primarily invested in companies in Australia and around the world, and the price of those companies temporarily drops, that's what we mean. That's what we're talking about. When it's said as the market fell, I think there's something dangerous here that happens, and I was just thinking about how people communicate that. It's almost like there's some omnipotent God who's in control of the markets, or as though there's a structure that the top two stories of the market are falling off a cliff. So the point here I'm making is there is no such. The market is a metaphor for willing sellers and buyers. There is no market. There is only that transactions that happen between people selling and people buying. The market is only that. If we think of the actual where that phrase come from is if you go to some country where they've got fresh produce, they're in a market and there's people haggling and buying and selling and doing those sorts of things. When it comes to buying and selling assets, that's what happens. Is that there's no one in control of that price. No one's setting that price. There is no one called the market, or there is no institution who controls the market. It's just a clearinghouse of there's people looking to sell and there's people looking to buy. So when we say the market fell, what happened is 100 people turned up on that day wanting to sell their shares in these companies, and 50 people turned up wanting to buy. And I know that's not quite how it works. Obviously, there's volume and all the rest of it. But if you think of that, it sort of helps to go, right, well, if we're there on that day and there's 100 sellers and there's 50 buyers, there's obviously going to be more people wanting to sell than buy. Therefore, the buyers will very quickly look around and go, geez, it's a buyer's market here today. I can actually offer a bit less than what I did yesterday, and I'll probably still get what I need. And the sellers are looking around going, geez, there's a lot more people selling than buying. I'll probably need to take a lower price in order to clear the produce that I've got. And so what happens is there's actually just all people making these little moment-to-moment decisions about, okay, well, I need to get rid of this asset. How badly do I need to get rid of it? Yeah, I need to get rid of it at any price. Okay, well, it's just that's what the price that I can get for it is today. And again, I fear that this is one of these podcasts. It's like an SBS movie that may have no end. But I think the point I'm trying to make here is not that there's anything that we can do about that. It's just that it's a different. When you think of it that way, it makes you put in perspective the fact that I own these shares in these great companies. The price of those companies is the market fell today. Oh no, the share market went down. There is no one who pushed that down. There is no institution who's decided. There's no genius who's sitting there all knowing and says that company is worth less money today. It just so happens that on that day at the market there turned up to be more sellers than buyers. Therefore the price went down. Therefore that's where the price is. If I'm not selling on that day, that price is completely immaterial to me.
Yeah, no, I think it's a good topic. So, because we don't often talk about this part of it.
No.
So, and you may be listening thinking, what are you talking about? I'm not going to any
market.
No one's turning up to the share market.
No.
What's happening though? That look, take a period of volatility. Forget that what's caused the volatility, but take a period of volatility for an example. So you have a lot of people that are members of superannuation funds, and they're instructing the fund manager of their superannuation fund to sell their bundle of the great quality companies of Australia and the world. Now, they're doing that usually by ticking a box online.
Yep.
Or they're doing it by filling out a PDF form.
Yep.
And mailing it in.
Yep.
So,
but that's what's actually happening behind the scenes.
If that letterbox for that particular fund is absolutely jam packed,
yep,
because people are fearful and people are scared, and there's 10,000 forms that day,
yep,
and they're saying, member number 1,252 says, okay, I've got $500,000 in there. I want you to move that all to cash, and then another member has $320,000 and it says move that to cash, and
yep,
that fund manager actually gets all those forms together,
yep,
adds all that amount up, and actually goes to the share market,
yeah,
and says, I am selling today,
yep,
and collectively here I have $50 million,
yep,
that I'm selling,
yep.
And they don't.
Well, they don't actually say $50 million. They have I have X amount of.
Well, that's right. I have this amount of shares that I'm selling. Good point. They don't reserve the right to hold that back.
No,
they reserve. They are under instruction, yep, via that form to sell for any price.
Yep.
So they.
Yep.
So whatever the price of those companies closed at the day before is what it opens up at, yep, for that particular day. If there's no one interested in buying,
yep,
then the price naturally moves down.
Yep.
And as the price moves down, more buyers become interested.
Yep.
And the price will move down or up, depending on how many buyers and sellers there are. So to your point before, Dallas, you have 100 buyers. Sorry, you have 100 people looking to sell, and you have 50 people only looking to buy. That's a mismatch.
Yeah.
The price has nowhere to go but down.
Yeah.
As the price falls, more people become interested.
Yes.
And the price will fall so that there's another 50 interested.
Yeah.
In a simple example.
Yeah.
So that the buyers and sellers can meet and
yep,
sell at that point in time.
Yeah. A great concrete way to put that is that, it's not like 100 individuals are turning up to the market to sell their shares. They're filling out a form and sending it off to their super fund. That's practically how that's happening. But that's what then happens behind the scenes. The super fund is not moving your money out of shares and into cash. The super fund is going and selling your shares. And then the amount of money that they get for those shares, they are putting into a cash account in your super fund. That's what's happening there. There's no the super fund or any one individual who's giving you this amount of money for those. It's just that is the price that you got for them. And I think so. The other point to your metaphor there of as that price drops, more people become interested, and so that's I think people's big fear is if you look at prices drop. So the market opens on one day and there are more sellers than buyers, and as you say, there's downward pressure on that price, and so people sell, and then there's sometimes a cascading effect where because the price is going down, people go, well, I've got to get rid of these. So if I don't get rid of them soon, then where will the price end up? What happens as that price goes down? Even people who weren't at the market on that day hear about it and go, well, hang on. Is that the price they're selling at? Well, geez, at that price, maybe I want to buy some. And so what you actually have is, and again, this is simply a metaphor. It doesn't actually happen like this, but minute by minute, there are buyers and sellers entering into transactions. And as that price fluctuates, you have people responding to that new price information. And so, a good example of back in my cattle farmer days, occasionally when you go to the Charters Towers cattle sale, and it's on every Tuesday, I think it was at the time. And one week you might go and there's more sellers than buyers, and because of that the price goes down. And what happens is the Bush Telegraph kicks in and people go, geez, they were cheap at that Charters Tower sale this week. Invariably next week more people turn up to buy because they go, geez, you can get a bargain here. And it finds an equilibrium where next week it might be that, well, the bargains are sort of gone because the bargains flushed out all the people who actually wanted to buy at that price. And so now they're back, and that's what's stabilise that price at that level. It's not the Charters Tower sale yards going, hey guys, we think that's what cattle are worth this week. It's just that we're holding a sale. Cattle are coming and they're going, and whatever price they go for is just what price they go for. And then next week we're going to do it again, and that information will become available. And based on what that price information, more or less buyers and sellers will turn up next week to take advantage of that. So,
yeah, and I mean, what you see with so the Charles Towers cattle market is an interesting market because there's willing participants in that market.
Yep.
What you have in Australia is you have so
Super
many
funds,
people that haven't made a conscious decision to be owners of the great companies of Australia and the world. They're just members of superannuation funds. In fact, they don't even know what they're invested into.
Yeah.
They become acutely aware of that when the price starts to fall.
Yes.
And what you're finding is that it's a lot of those people that are actually they're making the wrong decision, of course, by ticking the box to say to move into cash when the markets are down by 25% or 30% or sorry, when the buyers and sellers dictate that the prices are down by when supply
price.
and demand meet to suggest that the price is down 25% from its previous high. What happens is that effectively on the way down you have more panic to get out, and on the way up you have panic to get in, believe it or not. And what I'm referring to there is that usually at the bottom of the market downturn, whatever that is, in 2020 in March and April it was 37% down. When it hit the bottom, we can look back now at the end of 2021 and say, that was the bottom. What had happened on that day? Imagine the last person that was ever going to panicked on that day that it hit 37%. So the following day, the super
100
fund
buyers turned up and 50 sellers turned up.
The following day, the super fund manager opened the letterbox and thought, "Here we go again. I'm going to have to go and sell all of these shares." And there were no forms that came into the mail. It's a little bit of a simplistic example. But so 100 people turned up to buy, and only 50 sellers turned up that particular day. So the price went up. And hey, it did it again the following day. Only 50 people wanted to sell, and then 100 people turned up to buy. All of the people that were thinking about panicking have now seen 2 or 3 or 4 days worth of positive returns, and they start to be appeased. They start to not to panic. The people that are sitting on the sidelines hoping to get in for right at the bottom start to panic that they've missed the bottom. And then the following day, 0 people turn up to sell effectively, and 200 people turn up to buy.
That's right.
It's a little bit. I mean, it's a very, very simplistic way to think about it, but that's essentially what happens. That's essentially what happens as the price comes roaring back. And that's we're looking at very, very. All we're looking at here is short term volatility.
But that's
over the longer term.
The
price reflects the growing value of the company. So, you get Woolworths that had 5 supermarkets in 1925, and in 2021 they have over 1,000 supermarkets plus plenty of other brands and businesses. So the price, which has skyrocketed over that period of time, at what it should have grown by, reflects the changing value of that business. They've grown from a very, very small business to
a much bigger and more profitable
a huge business.
And I think that there's a famous saying that in the short term the market is a voting machine, and in the long term it's a weighing machine. So you go in the short term, that price is set by buyers and sellers. Over the long term, that asset is dictated by the profits that are spat out, or the return or the income that's generated by that asset. And so, I mean, a couple of thoughts about that as I think about my times at the Charters Tower sale. There's a couple of other things to add there, is that you don't know who's going to turn up day to day. So the whole concept of trying to pick and choose when to get in, when to get out. Like I distinctly remember one day going to the Charters Tower sale to buy some weaners to put in a paddock somewhere, And on that day, it just so happened that an agent for a buyer turned up, and he had to fill a paddock with 1,000 weaners. And so every pen that went up, he just went bang, 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 and the price went to whatever it went to, and he just blew everyone out of the water.
Yeah.
And so I drove home that afternoon going, right, well, I didn't want it as bad as he wanted it, and that's where the price got to. So you can't go to the market thinking, I'll try and pick which days there's going to be less buyers and sellers. It's not how it works. So the other thought that I just had about that as well is, we were saying in the short term, the market is a voting machine, is that there's always those people sitting on the sidelines that are opportunistic around that price has gotten to a point where it's now such a good buy that buyers come out of the woodworks. If you watch company prices drop by 30%, the human nature is that we extrapolate that and go, well, it's dropped by that amount. What if it keeps dropping and going to zero? And that's not how reality works. So again, the example of and my old uncle Darcy, actually, who goes to the Tower Sale all the time, and just as an opportunistic thing, there might be a pen of cattle there that no one wants to buy on that day, and the auctioneer is trying to start the bidding, and the cattle are never worth $0. You don't have 10 cows in a yard and go, well, last week they were worth 1,000 and this week they're worth $0. It just doesn't happen, because eventually the price drops to the point where someone who wasn't really that interested that day still goes, well, geez, I think those cows are worth way more than that. Yes, I'll buy them at $400 a head, or whatever the case may be. So if you think of it as that way, as in the short term, that market is dictated by the volume of people buying versus people selling, but it can't be worth $0. And we've talked about this before, where I think that's much more tangible for people with a house. If you own a house and you've paid $1 million for it, and property prices start to drop, the house never gets to zero. It gets to 600,000, and someone who's currently living with their parents goes,
someone snaps the bargain.
Someone snaps the bargain and goes, I can. Oh well, I thought I could never. I didn't ever think I was going to be able to move out of home, and well, for 600,000, I'll take that place. Or someone who goes, I know I can rent that house out for $1,000 a week, and I can buy it for 600. Oh, that's a pretty good deal. Yes, I'll buy it at that. So it's easy to forget that when it comes to this short term movement, and that again, when we talk about it as the market, it becomes this amorphous thing. But all of that short term volatility is ultimately just driven by willing buyers and sellers, and over the long term, ultimately, it's just noise. It doesn't reflect the intrinsic value of that asset, and it doesn't reflect where that asset price is going to go over the long term.
No, not at all. And I always like to put it back to a tangible example. So during the global financial crisis and during March of 2020, Woolworths didn't lose any of their supermarkets.
Yeah.
So, they didn't lose any of their supermarkets. What happened is their price fell, the share price fell.
Yeah.
And only got to a point where someone said, hey, that's a bargain. And they moved in and snapped up a heap of it at that point in time.
Yeah.
And then someone else went, well, I'm going to miss out because they've just snapped some up. So it will only get to such a point. You cannot keep going.
No.
I mean, owning a very, very profitable business that has more than 1,000 supermarkets and other brands and things like that, cannot get to zero. It just cannot happen. What happens is the price will fall. It's got some tolerance before someone moves in and snaps it up, and then it flips around. Like I said before, you now have a race to get in for people that have had money on the sidelines, and they as they realise that they've missed the bottom. They're starting to move in and buy up. The price goes up. Anyone that was considering selling now, if they see the price bounce 10% up from the bottom, they think, oh, well, I don't have to sell now. I'm not going to panic anymore. So suddenly you get it to swing around. That's what happened in 2020 was such a fast example of that. It took a bit over a month to fall, and it took about the same time to recover as well.
No, it's like we say, probably one of these things where we've talked a lot about the actual day-to-day, how these transactions occur and what that price movement does, and ultimately it doesn't. We've ended with it doesn't really matter, but I think it's just a useful thing to bear in mind is that, and I have this habit that tortures everyone around me, particularly my mother. She hates when I do this, but she'll often say, oh, well, they say this. I always go, who's they? Who's this magical they that you're talking about? And so I think for me, the main takeaway from this podcast is that whenever you read, the market lost this amount, or the market dropped by X%, or this amount was wiped off the share market, there's no market. Like if you think of it as, if you replace the share market with the Charters Towers sale yards, you can see that ultimately makes no sense. There is no, the Charters Towers cattle sale yards lost 30% today. The sale yards is just the clearinghouse. Some people sold at a price that maybe they will regret in future. Some people bought at a price that maybe they were happy with. The market is just the clearinghouse for those transactions. And ultimately, day to day, all that volume, all that noise, what you really need to think about with your retirement planning is, what are the assets that I ultimately will need to have accumulated by the time I retire? And most of the time you'll find that price day-to-day movement has no bearing on that. And like we say, that's why we always react. We always invest according to a plan, is so that what that price is doing day-to-day has no bearing on the fact that if I need to have accumulated this many dollars worth of shares by the time I retire, whether prices are up or down 2 or 3% for the day, or down 10% for the week, or up 5% for the week, has no bearing on the plan that I still need to work on.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.